Peter Lynch begins One Up on Wall Street by demystifying the stock market. He paints a picture of ordinary investors walking past extraordinary opportunities every day, unaware that they hold a unique advantage, first-hand knowledge of the products and services they encounter in daily life. Lynch's stories highlight how ordinary experiences, shopping at a supermarket, observing trends in your neighborhood, can reveal investments that professional analysts might overlook. The central idea is clear: the best ideas often start with what you already know. He stresses that investors should look around their own lives for clues. In one story, a casual observation of a popular retail product led to massive gains when the company's stock reflected its market success. Lynch emphasizes that anyone, regardless of financial training, can leverage personal experience to identify promising investments. The lesson is actionable: pay attention to everyday trends and consider how they might play out on a larger scale. Lynch divides stocks into 6 categories: slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds, each with distinct characteristics and strategies. He recounts vivid examples from his career, illustrating how understanding the type of stock shapes the right approach. By categorizing companies, investors can apply appropriate expectations, avoid common pitfalls, and allocate resources intelligently. Understanding the fundamentals of a company is paramount. Lynch walks readers through evaluating earnings growth, balance sheets, and management quality in a way that is accessible to non-professionals. He uses storytelling to show how analyzing these elements helped him identify undervalued companies poised for substantial gains. The takeaway is actionable: don't just follow stock prices, understand the business behind them. A recurring theme in Lynch's narrative is patience. He shares anecdotes of investors who panicked during market downturns, selling at losses, contrasted with those who held firm and reaped rewards. Lynch emphasizes that volatility is not inherently dangerous; it can be an opportunity for disciplined investors who have done their research. The practical advice is to develop a mindset that views market fluctuations as allies rather than threats. The book highlights the importance of 10-baggers, stocks that multiply tenfold in value. Lynch recounts stories of modest initial investments turning into life-changing wealth because of patience, research, and timing. He illustrates how spotting potential early, even in small or overlooked companies, can lead to extraordinary returns. The lesson is clear: think long-term, and don't dismiss opportunities that seem modest at first glance. Lynch also addresses the emotional side of investing. He shares narratives of investors who let fear, greed, or rumors drive decisions, and contrasts them with disciplined investors who follow data and logic. The actionable insight is that controlling emotions and cultivating rational decision-making is critical for long-term success in the stock market. One of his key strategies is the "invest in what you know" approach. He recounts examples of investors spotting winning stocks because they personally understood the product's popularity, quality, or innovation. This philosophy reinforces the principle that everyday insight can outperform complex financial models when applied with discipline and research. Lynch emphasizes diversification, but in a practical sense. He tells stories of portfolios that were overly concentrated in hot stocks and suffered, versus portfolios that balanced different types of companies and weathered market cycles. The actionable takeaway is to diversify thoughtfully, not excessively, focusing on a mix of growth and stability that aligns with your risk tolerance. Lynch explores how macroeconomic events impact sectors differently. He recounts examples where understanding industry cycles, such as retail booms or tech expansions, helped identify which companies would thrive. The practical advice is to observe broader trends without being distracted by noise, aligning investments with industries poised for growth. A recurring narrative is that simplicity often outperforms complexity. Lynch shares anecdotes of complicated strategies that failed, compared to straightforward investments based on solid business understanding. The actionable insight is that investors should focus on clear, understandable companies, avoiding overly convoluted businesses that are difficult to evaluate. He stresses the importance of flexibility. Markets evolve, and companies that were once thriving may falter. Through stories of changing industries and shifting consumer habits, Lynch demonstrates the need to continually reassess investments, ensuring they remain aligned with current fundamentals. The lesson is actionable: stay informed and adapt strategies as conditions change. Lynch also highlights the role of research resources, from company reports to direct observation. He tells engaging stories of how reading financial statements, attending product launches, or visiting stores yielded insights others overlooked. The actionable takeaway is that informed, proactive research gives individual investors a competitive edge. Ultimately, One Up on Wall Street is a guide to thinking like a successful investor. Through stories, anecdotes, and real-world examples, Lynch illustrates that ordinary investors can outperform professionals by observing trends, understanding fundamentals, exercising patience, and keeping emotions in check. The book leaves readers with a practical roadmap: identify what you know, research it deeply, act decisively, and hold long enough to let extraordinary results emerge.